Yeah, so I decided to make this video to explain one powerful concept when it comes to the market. That's liquidity. So we all know that we have internal liquidity and then external liquidity, right? I believe you know about that one. Planning on making some video on the type of liquidities we have. That's the internal and external. But then we are not talking about that. So let's just go with this. So today I decided to analyze for the FOMC news, which was at 6 p.m. And yeah, this was my analysis. As you can see, my SL was hit nicely. But then after hitting the SL, I decided to ask myself why. Because I was kind of confused why the market came to hit my SL. But then it's part of trading. But then I got to know that no, I didn't analyze as I should analyze. I didn't go into detail considering certain things. Yeah. Even though I knew that there was a nice fair value gap here, which was supposed to be filled by the market, yeah, I didn't consider certain things looking at the other side. So when I go to the 1 hour time frame, yeah, you can see it here. So on the 1 hour time frame, let's look at something here. So I was anticipating that the market will come up to this place, okay, to this particular order block, very nice one, to fill this particular fair value gap here. Then what will happen so that the market will come down? Because as you can see, there was a very nice form of liquidity here. Relative equal highs. Nice one here. So this was serving as what? Liquidity. It was serving as liquidity. So there was a relative equal high here, which was serving as liquidity. So that was what I was expecting. But then after the market took me out, I was asking myself, why did the market go up to test that level? So this is what I'll do. Let me just get a new gold chart so that we analyze it. Well, a new gold chart so that we analyze it with that one. Okay, good. So as I was saying, I was asking myself why the market came to this particular level from my previous chart. So this was what I was expecting. On 4H, or let me say daily. Let me go to daily first. On the daily time frame, what was I expecting? Good. So let me see 4H. Sorry. So before the market got to this place, I saw a very nice fair value gap, which was supposed to be filled. Now, this was it. Yeah. So I was expecting the market to totally fill this gap here, trade into this particular block here. A very shorter block on the 4H, and then the market to trade down. That was what I was expecting. I was expecting the market to fully fill the gap, the fair value gap, and then trade into our order block, our order block before the market sells. Now when you come to the 1 hour time frame, good, you can see that we can further refine our order block. We can further refine our order block to this very nice order block. Why did I take that one? Now I can see that there was an impulsive move to break this structure here. That's why I actually considered that one as my order block. So I had this break of structure here. Also, after having the break of structure, I also had some form of intended liquidity, relative equal highs here. I had some relative equal high here, serving as liquidity. So I was very sure that the market will come to test this particular order block and come down. But what happened? The market took me out. So if I were supposed to take this trade, and where will I be expecting my TP? Somewhere around here. This was where I was expecting my TP. Let's see, somewhere around here. Good. So if I were to be taking a sell, let me put my sell here. Good. I would have been taken out easily. But then, yeah, I was taken out. But I was asking myself, what happened? Why? So I decided to go back down to the 15-minute time frame. Now, on the 15-minute time frame, even though we have our liquidity here, which was taking, I found out that there was something here that I didn't consider. Yes, right above this place. Now, right above this level, let me just zoom. Yeah. Now, right above this level, there was this relative equal high. Now, you know, when an order block is being mitigated, I actually don't look at it again. So that's why I didn't even consider it. So I know that this order block has been mitigated this one, but this particular 15-minute order block here wasn't mitigated. And right this particular 15-minute order block here. Now everybody have his own a way he or she takes his order block. So yeah, depending on how you consider what your order block is, that's how I also consider my order block. Now right below this particular order block, what did I see? I saw a very nice form of liquidity. Even two forms of liquidity. Now mostly, for me to say an order a fair value gap has been filled, it should be filled 50% or above. Yeah, for me to consider it to be filled, it should be filled 50%. Now, looking at below that place, I had a very nice fair value gap here. Very nice one. There was a very nice fair value gap here. Let me indicate it with let me say red. Good. There was a very nice fair value gap there, which was what? Not fully filled. It wasn't even half filled. When we take our let's see if it was half filled. Good. It wasn't even half filled. You can say it wasn't even half filled. So right below it too, we had another form of liquidity, which was also in the form of relative equal highs. This is not very equal, so that's why I call it relative equal highs. You can see how slanted it is. So this is also another form of liquidity. So nice that the markets. So I was trying to ask myself why the markets actually traded into that level before coming down, and then I found out that yes, liquidity is what moves the market. Like wherever there's liquidity, the market tries to go there to clear out liquidity. And if you don't really know about liquidity, you'll always be taken out. You'll always be taken out. So after coming to this 15-minute time frame, then I found out that, oh, damn, I should have taken my trade using this. I should have considered all this to enter my trade. I should have looked at all this. So if I would have looked at all this, like I wouldn't have placed my order here. My order would have been somewhere around here. Good. This was where my order would have been. As simple as this. And where would my TP be? This place. And this one would have been giving us 1:18 risk to reward. 1:18 RR. You can see it right here. So nice and easy. So you can see how the market moves with liquidity. Wherever there is liquidity, the market goes in to grab liquidity. So this was a very nice trade. In fact, you can see there was a break of structure here, nice liquidity sweep, serious one, and the market is still moving. Actually, how many pips now? 359 pips. Yeah, 359 pips. I'm expecting it to come 400 pips. Yeah. So this was a very nice trade. Yeah. I actually missed it. I really missed it. Right after missing it, and I found out that, oh, so this was the reason why I missed it. I didn't really pay attention. And That's one thing. As a trader, you need to have full attention on the market. You need to understand what you are doing. You need to you need to concentrate on the market, so that simple liquidity you just miss a place where there's liquidity. You just miss it out, and then your SL will not be missed. When you miss, your SL will not be missed. Alright, so I hope you enjoyed the video. Thank you. Please try to subscribe for more videos.